Well, good evening, Factor members. It's Peter. It's Monday evening, President's Day in the U.S., February the 19th. I want to show you a trade that I put out on member Twitter today, but I want to unpack it a little bit for you. It's a trade for which I've entered orders. I want to explain the trade itself, then I want to explain the execution as at least I see it right now. Obviously, that's subject to revision. And just a reminder, this trade I'm looking at to do for myself, whether or not you do this trade, you need to decide whether this trade is suitable to your trading style. If you take this trade, it's your trade. You need to own it as your own and execute accordingly. So, in any case, I just want to show that we have kind of a complex head and shoulders top going on here in the June pound. You can see again, all these dots back here are because it's a June contract. If we go to a continuation chart, we see, a filled in chart going back as far as we can go. But you would see this same pattern on a continuation chart or on the spot cash contracts as well. But we have a left shoulder head, which is a complex rounding type head in and of itself. We have a right shoulder. We have a right shoulder low, which is pointed out here in the June contract at 125.37. We've got the 18-day moving average, which is the orange line is rolled over. 8-day moving average is rolled underneath it. Both are aimed down. Now, let me talk about the commitment of traders here for a minute. Commitment of traders reported by the CFTC every Friday as of positions earlier in the week. And we have a very large spec net long position. Now, keep in mind, when we talk large spec, we're talking about reportable positions. And for the most part, that's hedge funds, very large trading operations, commodity funds, and so forth. Uh, but I'm not going to go back into history. We had a similar large spec long position back at the July 2023 high. But if you go back further than that, what you'll find, you have to take my word for it, is you have to go back just about 17 years to find substantially larger net long position on the part of hedge funds and commodity funds. And so we're at historically large spec positioning in this market. Now, I've talked about this in the past, but all things being equal, I want to trade against the large spec and with the commercials. And so I want to trade against the large spec, but I don't want to always trade against the large spec just because they have a large position. I want to trade against the large spec when two things take place. First, that large spec net long position is historically large, which in this case it is. And secondly, when we have a pattern that supports it. In this case, we have a 13 week or 3 month head and shoulders top, which for me lands really right at my sweet spot. It's 8 to 16 week patterns are really my sweet spot. When you look over at this pattern on a weekly chart, we can see that it does trace out the moving average or the head and shoulders pattern. So we go back here. I've already calculated these numbers, so just bear with me. So I took a look and say, what percentage of the 13-day ATR do I use for a sell stop, when we have 13 weeks? And my formula, and I've shared this with Factor members, is it's about 40%. So I calculated 40% of the ATR. Now, which ATR day do I use? I always use the last bar that is still within the pattern, that was fully within the pattern. So that's the bar that the CMA attributes to today, Monday. Even though today was a bank holiday, we had trading in British pounds. We had a high, we had a low, we had a close. And so I'm looking at that. I know the ATAR, and I calculated what 40% would be, and it ends up for my sizing represent a 60 basis point trade, which if I'm filled will be divided into two tranches of, it could be five each, could be a 6 and a 4. I'll have to determine what that is once I'm filled. But I'm basically down here at a 125.07. Now, actually, the ATR when I use 40% was like 125.12, but I always like to have my stop just a little bit below the even, an even number. So even numbers for me in the pound would be 125 even, 125.10, 125.20. Now, obviously, 125 even is a big even number. 125.10 is kind of a minor increment even number. So I wanted to just be just below that. So I chose 125.07. Actually, the order is 125.07, sell stop with a 125.04 limit. Now, when I look to determine the sizing, I base that on the fact that I would use, and again, this can always change the day of execution, but at least going in to Tuesday's trading, I peg my buy stop if I'm filled at the sell stop at just above Monday's closing price. And so, actually, it worked out that my buy stop was up at 126.06. So about 100 points. So I'm risking about $625 per contract, or in a 10 lot, 63 basis points. With a target, a measured target, and again, I ballpark these numbers. I use a drawing tool. I don't actually determine what is the low. You kind of end up in a paper bag you can't get out of when you do it that way. You take the distance from the left shoulder low to the head. If it's a complex head, you use the median of all of the highs. I ballpark these. I think people are way too exacting when it comes to target. I can always change this. If I end up with a profitable trade and it breaks out and it moves in my direction, I'll always have a day or two to really tweak that target. But for right now, 122.52 target. Again, that is slightly above the even number. Because if I'm buying, I want it to be slightly above an even number. If I'm buying on a stop, I want it to be slightly above that even lot number. So that's my trade, selling 10, buying 10 on a stop. If I'm filled, I'll split it into tranches. I'll probably move the stop on, if I'm filled, let's say on Tuesday. Chances are that I'll look and see what Tuesday's high is before I get filled, but I'll be looking to split the 10 lot into tranches and moving stops on at least half of it down even tomorrow. So anyway, I hope this is helpful for you. If it is, let me know.